Welcome to this explainer. Have you ever looked at a cryptocurrency chart and felt like you were just staring at a total chaotic mass of random lines and colors? Well, if so, you are absolutely in the right place. Today, we're going to transform all of that chaos into a really structured, stress-free system. We're breaking down a comprehensive guide for beginners, focusing entirely on how to read the market's true language instead of just relying on pure guesswork or, blind luck.
So let's just dive right into it with the question we've all asked ourselves at some point. Why does Bitcoin just suddenly shoot up? And actually, more importantly, how does some professional traders seem to know exactly when to buy, while the rest of us are caught completely off guard? I mean, is it a crystal ball? Insider information?
Well, the reality is a lot more grounded than you might think. A ton of beginners, they rely on social media hype, random Telegram rumors, or just that overwhelming feeling of FOMO, the fear of missing out. But professional traders, they use a strictly evidence-based approach. The source material actually uses this brilliant analogy. Think of an experienced merchant in a busy Legos market. They don't just guess before buying bulk stock. They observe. They actively watch customer behavior, supply, and demand. Crypto trading is exactly the same. But instead of observing physical customers, we observe price charts to make structured, logical decisions.
So here's exactly how we're going to build your trading mastery today. We'll cover the language of the market, reading crypto charts, spotting invisible boundaries, technical indicators, and finally, surviving with risk management.
All right, part 1, the language of the market and understanding the basics.
Now, the absolute most crucial thing to get here is that technical analysis, or TA, is not a crystal ball. It doesn't predict the future with 100% certainty. No way. Instead, it's really just a tool that studies what the market is actually doing, rather than what people on the internet think it should do. Think of it like using a map before traveling to a completely new city. The map doesn't remove all the risks of the journey, but it definitely drastically reduces your chances of getting completely lost.
And one of the very first things that map tells us is the trend. Because prices almost never move randomly. They generally move in 3 main trends, driven by the incredibly intense human emotions of fear and greed. In an uptrend, raw optimism pushes prices to higher highs. In a downtrend, fear totally takes over, creating lower lows. And sometimes, the market just moves sideways, basically consolidating in a tight range while buyers and sellers try to figure out what's coming next. There's a famous rule among traders: the trend is your friend. Following these trends is always safer than trying to fight them.
Moving right along to part 2, reading crypto charts and the anatomy of a candle.
So, professional traders overwhelmingly prefer what we call candlestick charts. Actually, think of each candlestick as telling a tiny little story of a battle between buyers and sellers over a really specific period of time, whether that's 1 hour, 4 hours, or an entire day. That thick part in the middle, that's the body, and it shows the opening and closing prices. And those thin lines sticking out of the top and bottom are the wicks. They show you the absolute highest and lowest prices reached during that specific battle.
And really, this brings us to the absolute simplest rule of the market. Color is literally everything. A green candle means buyers totally dominated, closing the price higher than where it opened. But a red candle? That warns us that sellers took control and pushed the price down. By reading these candles, you're literally watching human psychology play out in real time.
Okay, part 3, spotting invisible market boundaries, which are support and resistance. Have you ever been watching a price drop and noticed how a coin will just suddenly bounce back up at a really specific price point? It's almost like it hit a completely invisible trampoline. Well, let me tell you, it's definitely not a coincidence. That invisible floor, we call that support. It's basically a price zone where buyers just consistently step in because they perceive the asset as a total bargain. The source uses this really great example. Imagine Bitcoin dropping to 100 million Naira. Every single time it hits that specific number, buyers aggressively rush in to scoop it up, creating this solid floor that stops the price from falling any further.
Now on the flip side, we have resistance, which is the exact opposite. It's the ceiling where sellers step in to take their profits, preventing the price from rising any higher. And the golden rule you absolutely need to remember here is this concept of role reversal. Once a resistance ceiling is finally smashed through by really strong buying pressure, it very often turns into the new support floor. So when these support and resistance levels bounce off each other over days or weeks, they start forming these recognizable sentences or chart patterns. And these shapes just reflect predictable crowd behavior. For instance, a head and shoulders pattern strongly warns of a bearish downward reversal. A double bottom,
which literally forms the shape of a W, signals bullish momentum because sellers failed to break support twice. Triangles show a market resting up before a massive breakout. And flags? They show a brief little pause before a trend continues. Learning these patterns helps you anticipate really high probability opportunities.
Which brings us to part 4, technical indicators made simple. Basically, your market assistants. You can kind of think of these indicators as your own personal analytical assistants. Moving averages smooth out all those chaotic, bumpy price jumps to show you the true trend direction. Then you have the RSI, or Relative Strength Index, which measures momentum. That tells you if the market is getting just a little too excited and overbought, or way too fearful and oversold. And volume is absolutely essential. It literally tells you how many people are actually participating in the move. A breakout with high volume? That's trustworthy. But a breakout with low volume is very often a trap. Oh, but a strong warning from our sources here. Keep it simple. Overloading your chart with a million indicators is a massive beginner mistake.
And finally, we've reached part 5, surviving with risk management, the ultimate golden rule.
1 to 2%. Literally, just edge this tiny little number into your brain. This fraction is the absolute maximum percentage of your total trading capital that you should ever risk on a single trade. Like, if you have ₦1 million, you risk 10 to 20,000 per trade, tops. Even if you hit a terrible losing streak, simple math ensures you stay in the game long enough to actually learn and succeed.
So how exactly do you enforce that strict 1 to 2% rule? You use a stop loss. This is an automatic exit order that closes your trade instantly if the market turns against you. By rigidly using a stop loss, you guarantee that you know your maximum possible loss before you even click the buy button. It just takes all the messy human emotion completely out of the equation.
Because honestly, good risk management protects you from the two absolute most dangerous, account-destroying forces in the crypto world. It stops fear from making you panic sell at the absolute bottom, and it stops greed from pushing you into frantic revenge trading just to win back your losses. But honestly, more importantly, it gives you the complete peace of mind to hold on to a winning position without accidentally turning it into a loser.
Okay, let's pull all of this together into a really simple, highly actionable checklist. This totally replaces pure emotion with cold, hard logic for every trade you make. Step 1, identify the trend using a moving average. Once you've got that, step 2 is finding your invisible support and resistance zones. Next up, step 3, you check the RSI to make sure the momentum is actually on your side. And finally, step 4, before you do anything else at all, you set your stop loss to manage your risk.
There's a quote from the source material that just brilliantly sums up this whole philosophy. Wealth in trading is not built in a day. It is built through consistency. It's not a get-rich-quick scheme at all. It's a disciplined skill. It's the art of managing your unavoidable losses, aggressively protecting your capital, and letting your winning trades grow steadily over time. So, the very next time you pull up a crypto chart, I want you to remember that seasoned merchant in the Lagos market. Look right past the chaotic flashes of red and green. Find the structure, find the underlying trend, and ask yourself what the buyers and sellers are really trying to say. Because the market is speaking to you every single second. The only question is, are you finally ready to listen?